All right, well, thank you very much and welcome everybody to the Cindy Bishop Worldwide webinar. Today, we're excited to have Mike Ott with First Heritage Mortgage talk to us about the impacts of the coronavirus on the mortgage industry. If you haven't had the chance to work with Mike, I certainly encourage that you give him a call or reach out to him. I met Mike through First Heritage and his relationship with our brokerage, Sampson Properties. And I guess what really resonated with me is Mike has got that educator's personality and approach, being a former teacher himself. And he's just been a real joy to work with. And I'm not just saying that because he's on this call. So if you haven't had the chance, he's really been wonderful to work with, does great with my clients, and really looks out for their best interests. So I highly recommend that you do that. He's got a tremendous amount of experience and is a great resource. So I guess without further ado, Mike, I'm going to open this up to you. We're looking forward to what you're able to share with us today.
Awesome. Thanks, Gary. I appreciate the kind words there. And good morning, everybody. And thanks for hopping on and joining us. I want to give you a real quick kind of just a background on the genesis for putting this together. I was talking with Cindy last week, and we were talking about content for webinars and for CE now that we can do it, at a distance and online. And I said, I shared an example with her of, I heard on a different podcast where real estate agents were actually using the current forbearance offering from the federal government for mortgages. They were offering that as kind of a sales technique, basically with a message of, hey, come buy this home, and then automatically apply for a forbearance and have the next 6 months with no payments. And I thought, oh my gosh, we can't have this happening. And I said, can I get on and just take, maybe 30, 35 minutes, whatever, just to kind of update the realtor community about the ins and outs of the forbearance offerings, but also to kind of clear up some of the misconceptions, but to also comment on that, in my opinion, and I think a lot of mortgage professionals, is that this has been poorly communicated by the government, and it's been a real sticking point, and it's kind of got, and I hate to say this, but it's kind of got crisis, and we're going to talk about liquidity crisis with loan services, but it's got that kind of written all over it. And I just kind of wanted to put out some information kind of in terms of facts that I know right now. I'm not going to sit here this morning and say, hey, I have all the answers. I know everything that's going on, because this stuff is changing daily. And the updates are coming in, and the change to the loan programs. It's extremely challenging to kind of keep up with what loan servicers and mortgage-backed securities investors on Wall Street are willing to take on during this kind of crisis, with the result, as a result of the coronavirus. And, we've got the shutdowns and the, shelter in place mandates, and we've got people out of work. And there's a lot of pain points here. And the forbearance program is really geared towards those people that actually, need it, but it's been basically opened up, and we'll talk here in a few minutes about how it's been basically opened up to anybody, and that's kind of what's scary right now. But I want to kind of paint a picture for you, and I, due to lack putting this together very quickly over the weekend and lacking artistic merit, I really didn't have a good infographic, but I want you to, if you can, visualize this kind of chain of events, or this assembly line, if you will. You've got home buyers with a mortgage, right? And they make their payments to a mortgage servicer. And then the servicer has to send those payments to the bondholders and the mortgage-backed securities investors on Wall Street. And I don't want to get real, too technical about it, but I just want you to think of that flow of money, right? Homeowners pay the servicers, servicers pay the bondholders. Everybody's whole, everybody's happy. Enter coronavirus and people out of work, and the government, in short, the government saying, okay, well, we're going to have to put a plan out there to help some of these struggling homeowners that are going to have trouble making their mortgage payment. And they basically came out and said, hey, we're gonna kind of open this up to the homeowner that's been impacted by the coronavirus. And all they would have to do is attest that they've been impacted in some way, shape, or form. And on a couple slides here, when we get to it, I'm going to kind of show you the thing that scares me the most is that any one of us who have a mortgage could actually take advantage of this just by calling the loan servicer and saying, hey, I've been negatively impacted by the coronavirus. And the system of checks and balances where you would think, and a lot what we had during the meltdown in 2008 is for these people that were struggling and needing loan modifications, they actually had to provide the documentation, the proof, and the evidence that they were out of work or that they financially had some type of hardship where they could not make the mortgage payment in order to be eligible to do a loan modification or a deferred payment plan or a forbearance. And right now, the way it's been publicized and actually the way it's written is that it's basically kind of open door for anybody with a mortgage could take advantage of this. And unfortunately, I think we're going to see, with the misinformation that's out there, we're going to see a lot of people thinking, oh, well, I'm still employed. I'm still making my, generating my income and I can make my payment. But if they're going to give me a free lunch for the next 6 months, then, hey, I might as well call my servicer and see if I can go on a mortgage vacation here for a few months. And that's what's scary about this, because what it's going to do is it's basically putting a liquidity crunch on these servicers. So if you go back to that conveyor belt, if you will, of the payments going to the servicers and then the bondholders being paid, well, there's a little hiccup in that system. If the forbearance comes into play and the homeowners are not making the payments to the loan servicers, right? Because that's who's been, the initiative is at the loan servicers. You must accept a forbearance request from any homeowner that says they're impacted by coronavirus. And they have a 6-month forbearance term that could be reapplied for at the end of 6 months for another 6 months. So you're talking about potentially a full year for somebody to take advantage of the forbearance. The problem is that if the servicers in the middle are still on the hook, because you've got the bondholders, the broker buyers, and the mortgage-backed securities investors, for lack of better terms, let's just say Wall Street, sitting there saying, hey, you owe me, show me the money. They don't care. So now what that does is that puts the servicers in a very tough position that basically they're going to have to, find ways to satisfy the bondholders and make those payments, but yet they're not receiving that money from the borrowers who are in forbearance. And to date, for Fannie Mae and Freddie Mac, the Federal Housing Finance Agency has not put in place any type of liquidity facility to assist the servicers. So you've got servicers that, I just heard the Mr. Cooper is, I think, the largest non-bank mortgage servicer. And as of last Friday, they had 86,000 of their borrowers applying or, requesting the forbearance. And what was scarier is that they said they're getting 22,000 requests a day. Now, we're, for the most part, fairly early in this, the chaos of the virus's impact, that if this continues, that's going to seriously put the loan servicers in the middle in an extreme pinch. And as of right now, with no help whatsoever from the federal government. So that's kind of what's scary and why I wanted to kind of jump on here. And for those of you that are working with, home buyers that are kind of out in the marketplace, we've got the loan servicers now basically tightening up guidelines. And one of the bullet points here on this slide is credit overlays. One of the things that they're doing is they're gonna mitigate their risk, right? And they're gonna stop doing some of the riskier loan products or the riskier lower end FICO scores, or they're going to have more people have skin in the game, or in this case, skin in the bank. They're increasing the asset reserve requirement. Not that they have to use that money to buy the house, but they have to show that they have, 2-3 months reserves of their principal, interest, taxes, insurance payment in the bank before they would even, qualify for the mortgage loan. We're also seeing debt to income ratio limits being tightened up and lowered, where, just to give you an example, Fannie, Freddie conventional loans going through their automated underwriting systems, a lot of times they would let a borrower stretch their debt to income ratio to 50% of their gross income. Well, and now what they're doing is they've reconfigured these systems, and they're going to lower that threshold, and let's say 45%. Some are going to set it to 43%. And essentially, it's going to kind of, it's going to weed out the more riskier borrowers, and that's going to. I put it to a realtor partner last week. I said, we had this one gentleman we were working with, and he was a 640 FICO score, veteran borrower looking to use the VA loan. Well, the VA hasn't changed and change their guidelines. It's the servicers and the investors now that are gonna take on and purchase these loans, and then sell to the bond investors, that they're just willing, they're not willing to take on the risk anymore. So we had a 640 FICO veteran borrower who was pre-approved 1 week, and all of this comes down the pike and hits, and now all of a sudden investors are putting for your government loans, a lot of the investors are putting a minimum FICO score of 680, whereas the typical government loan would go down to 640, 620. So you've taken, you've basically eliminated a significant portion of the potential buyer population utilizing the government loans. And I have on here also lenders and programs kind of disappearing, or I put there being temporarily shelved. I'm getting probably 3 to 4 emails from different servicers and investors where they're pulling their programs off the shelf, and we no longer have the ability to offer them to the consumer. And one of the big spaces is the non-QM, or the non-qualified mortgage. Several of you have probably heard of these, referred to as like bank statement loans, or the programs that give the ability for people to, create an LLC and then buy investment properties. Within the last 2 weeks, the non-QM market is completely dried up. There's probably a small handful of these investors that are still in the marketplace, and I'm thinking, and I don't think I'd want to be the last person standing in that particular space right now. Jumbo loans for our area is when a loan amount is be above 675, 651, right? And that's our DC metro area. Now, as you get to the, for those of you that are out a little bit further out from the bullseye of Washington, DC, those conforming loan limits or high balance limits are a little bit different. But for our immediate metropolitan area, a lot of these jumbo investors are basically saying, okay, now it's 20% skin in the game for the buyer, or we're not entertaining these loans. Whereas some of them were allowing, believe it or not, as little as 5% down, and most of them had a 10 or 15% down kind of space in the marketplace. And that's pretty much, they pretty much pulled that from the shelf and constricted those guidelines to say, hey, we're going to do this loan, the buyer's going to have the 20% down kind of by the traditional means. And then there's the impact on, interest rates along with this. So if the servicers aren't, going to be collecting these payments, or essentially what they're doing is they're saying, hey, if we're going to have this influx of forbearance requests, and we're going to be basically selling our assets just to stay afloat if the federal government's not going to help, well, we have to kind of build in protections as we go forward. And here's where it's impacting the people that are entering the housing market and trying to buy first-time home or to do that move up buy, because what the investors are doing now is they've basically increased their margins. Now the translation to the consumer is that's going to mean higher interest rates, or the low interest rates that are still available. And I'll say that we're still historically in great shape with rates. And a lot of the programs are still kind of a sub 4% interest rate, which is great, but it's not. Computer went to sleep. Bear with me a second. My back. Sorry, my screen fell asleep.
Yeah, I still see you, Mike.
Okay, good. Where was I talking about? The higher rates. So these rates historically still good. Sub 4% rates, but the problem is now is they're not without a cost. Lenders are starting to see the rates when they're priced on a daily basis that, while the rate itself is attractive to hold it for a particular lock period, the borrower is going to have some skin in the game in the form of discount points to kind of hold that rate for those, for the desired lock duration. So that's why I put in there, most rates are now priced with discount points. So it's basically kind of, if you will, shrunk the rate sheet for lenders. Rates are still good, but the cost of getting those rates is definitely being passed on to the consumer. And again, that's obviously making it tough. For you as the real estate agent working with that buyer, and let's say I've seen this over and over in the last 3 weeks since a lot of these restrictions have been put in place. The first-time buyer is typically your buyer that's kind of hurting in the capital department. And now you talk about average closing cost to the buyer in a real estate transaction of being 3%, for the loan costs. Well, now if they're paying a point just to get a rate where they qualify for the loan or where they feel like they can manage the payment, you've just increased that cost to 4% for the buyer. So it's making it that much more challenging. All right, let's advance here. Talk a little bit more specifics about the forbearance. So as part of the CARES Act, here are some of the details about the forbearance, and I kind of mentioned some of these, so we'll breeze through them. I think, as I mentioned, one of the scarier aspects is that the borrower can just attest to being impacted by the virus and that there's no documentation required, right? No pink slip or no pay stub showing reduced hours on the job where they might be impacted and be put in a position to struggle to make the payment. The initial forbearance is granted for 180 days or 6 months. It's written in the literature and in the law that it can be extended for another 180 days. So you're talking about potential of a full year's worth of going into a forbearance. And the lenders and the servicers have been instructed that they cannot report past due amounts on the mortgage accounts to the credit bureaus. But here's one of the unintended consequences, and one of the things that I don't necessarily have a 100% answer to, but it begs the question, what is being reported to the credit bureaus for the people in forbearance? I'm trying to figure out, how is the credit score algorithm going to treat anything other than a mortgage account being labeled as paid as agreed? And this is one of the things where they're not really upfront. The impact to people's credit going into forbearance is a huge question mark. And I'm going to err on the side of worst case in my conversations with anybody that asks me about it, because it's so unknown, is when the federal government can say, hey, you can't report it as past due. Well, then what do they put? if they put other language on there like in forbearance, that's not paid as agreed. I could easily see, I don't have any proof or any particular research, but my concern is that I think we're going to see people negatively impact in their credit scores by entering this forbearance. Now, while some people aren't going to have any choice and they desperately need it, that's one thing. But if the floodgates are wide open, that anybody could do this without showing any documentation, we could have some people that are, good credit people thinking they're getting a free lunch and then have their credit at risk. And it's not about right now, it's about that future lending, whether it's a car or a home loan, home equity line, whatever the case may be. There's a huge question mark looming is what is that impact? How's that going to impact your future ability to get financing? And I've got a couple more thoughts on that with a couple of these other points. So here's the forbearance agreement, right? Like what happens at the end? And here's kind of this is again where each individual servicer is going to basically create an agreement with the borrowers. But some of the options that are being presented is that once the 6 months is over, and let's say the homeowner's back to work, well, one of the things the servicer is going to do, they might structure the agreement so that the lump sum of the payments that were missed for the 6 months are due in month number 7. And that's month number 7 since the beginning of the forbearance period. Now, think about this. I've got some notes here, some quick math. If the mortgage payment's $2,000 a month, right, and they go into forbearance for 6 months, the servicer is keeping track now of a running total of $12,000. In month 7, they're back to work, income's coming back in. The servicer is going to expect not only that month 7 $2,000 regular payment, but the catch up in lump sum of $12,000 for a grand total of $14,000. That's one possible scenario. So now think about that. What you already have a financial hardship if you can't make the $2,000 payment. But what good is it going to do for the person who's out of work for 6 months, let's say, generating no income? How are they going to save $12,000? So then I can see the servicer saying, okay, well, here's what we'll do. We'll divvy that up. Let's say we're gonna take that $12,000 in forbear payments, and we'll divide that up over the next 6 months to $2,000 a piece. And for the next 6 months, starting in month 7, you can make a payment of $4,000. Well, that's just doubled their mortgage payment. I can easily see the homeowner saying, I can't do that either. Right? And then what's the next step? Well, what are my other options? Well, we could do a loan modification. And here's where I think the credit impact comes in. Servicer may be able to do a loan modification, stretch the term, do something, right? Kind of like what was done in 2008, modify payments, but then that will be labeled on a credit report as a loan modification. And again, I think what we'll see is a lot of people that did modifications and then wanted to either try and make it their next purchase or a move up buy, or to even do a refinance, that if you had a loan tagged, as being in forbearance or having a loan modification, they were putting similar wait periods for you to get removed from that negative credit event, a lot like they were doing with short sales and foreclosures. So conventional financing, if you have a short sale, right, you got to be 4 years removed from that. So what if they do a loan modification after the forbearance? Does that then put them in another wait period before they could do another financing option, such as a refinance, of that mortgage? Because that's going to be the next thing the consumer asks. It's like, well, I can't do the lump sum. I can't afford $4,000 a month in that scenario. And I really don't want a loan modification toasting my credit or impacting me being able to obtain credit or be able to do a refinance. And then that's what they'll say is, can I do a refinance? I bet you that the services are going to probably say no, because your loan's been in forbearance. There's a lot yet to come down the pike as we get to people that do the forbearance and then get to the end of the forbearance period, a lot more information is going to come out. Right now, again, I don't have all the answers. It's not that clear even to us in the mortgage industry. I have payment deferral listed there, right? Now, payment deferral is the idea that what they'll do is they'll take the sum of the payments during the forbearance period and they'll just tack it onto the outstanding loan balance, which might seem like the best avenue for people to go, but I'm going to try and do a different, share a different screen here momentarily and show you what Fannie Mae said in their letter about payment deferral. This is the thing that concerns me the most, is right here for eligibility criteria for a payment deferral. I've highlighted here the mortgage loan must meet the following delinquency parameters. Delinquency parameters. That means before they're even going to entertain doing a payment deferral, it says here as the date of evaluation, the mortgage loan must be 30 or 60 days delinquent. Their credit's already toast at that point. Right? They may go through and meet that criteria. The other thing that I thought was really challenging and puts a whole lot of people out, I can scroll down here and find this. I found this criteria to be interesting. The mortgage loan must have been originated at least 12 months prior to the evaluation date for a payment deferral. Well, that basically just cuts out everybody that got a loan further back in time, further than a year ago back in time. You can't sit back and say, oh, well, people that got a mortgage loan prior to a year ago are not going to be impacted by this. So those two things kind of stuck out and were very concerning to me. And it'll be interesting to see, if the guidance changes. This talks about the idea that, if you get into the deferral, that the balance would be due at the mortgage maturity, and that would be upon sale of the home, right, or transfer of the property in one way, shape, or form, or a refinance, right, or payoff of or payoff in some way, shape, or form. Okay, so, but I think getting into that and be accepting into that deferral payment plan is going to be pretty catastrophic, or has the potential for being catastrophic for people and their credit as they kind of move on in life and are going to need other need financing for other things. My last 2 points on here were kind of what I referenced earlier with the Federal Housing Finance Agency to date is they are not putting any plan in place to provide any type of financial aid to the servicers of Fannie Mae and Freddie Mac loans. Again, that continues to be the scary point for me, as the mortgage lender. I do think that when push comes to shove, and if this forbearance event does take a kind of a nasty toll, that I think, I like to think that some aid is going to, now whether it comes from the Federal Housing Finance Agency or the Federal Reserve or the Treasury, I can't see them letting mortgage companies, especially in the non-bank mortgage side, which you have quite a few. It's like for my company, First Heritage Mortgage, that they're going to let a lot of these companies fail who employ thousands of people. I think that somebody will jump in, something will be done. But the problem that I have is that, in my opinion, they're not really taking a proactive measure, and they're going to be in a reactive state, which is, could cause us some issues in real estate and mortgage. Now, Ginnie Mae, my last bullet point there's, silver lining for the government programs, FHA, VA, and the USDA Rural Housing Loan. Ginnie Mae is actually going to have what's called a pass-through assistance program that will provide the servicers of the government loans liquidity, and they're actually going to dip into HUD. And HUD itself is said to be in a position where they can kind of weather this storm, make the servicers whole, and also then, in turn, keep the bondholders whole on the back end of this. This chart here was basically kind of just outlining. It was put out by Freddie Mac. Basically highlights some of the points that we talked about. But I've got a couple articles here. The letter that I referenced directly from Fannie Mae, and then the CFPB video. I would highly recommend all of you taking the 3 minutes and 49 seconds to hear their message about forbearance. And remember, their job is to protect the consumer in all things financing related. And they've put together, to the best of their ability, in my opinion, a video with guidance to people impacted by the virus, but also to us in the industry, to kind of explain, the ins and outs of this and what some of the options might be. And I think they leave it pretty open-ended that, you'll find that different servicers are going to treat this and structure their options a little bit differently, all within kind of the overall umbrella that's been set forth by Fannie and Freddie and the Federal Housing Finance Agency. And then the web link down at the bottom is a good kind of for the consumer, kind of like, hey, what are my steps? So if you have clients, past clients that might be in touch with, and they're expressing that they're in facing the financial hardship, that bottom link there is a very good website to send them for. It gives them kind of step-by-step instructions on how to find out if your loan is in fact backed by the federal government, instructions on what to ask when they make the call to the servicers about what their options are. So some pretty good resources there. And a couple of the other articles just kind of explain, again, some of them get a little technical, but if you're interested, those are good resources